Hello everyone, welcome back to Upside Down Data. In this video, I'm going to talk about bear market strategy. I'm going to explain what I think is the right approach to navigating the bear market and point out some assets that I think are the right ones to focus on. So if you guys like the content, subscribe to the channel, give the video a like, and let's get into it. So where are we in the market cycle? Let's start with that. Looking at the weekly Bitcoin chart, we can see that we have reached pretty dramatic new lows. I mean, people often argue that the 20-week moving average is an important line in the sand that tells us whether to expect bullish or bearish price action. I've got the 20-week moving average up here on the chart. This is in blue. And the price of Bitcoin is currently more than 70% below the 20-week moving average. So that's not even really relevant at this point. Actually, what we're seeing now is consolidation below the 200-week moving average, which I have up here in yellow. That has simply never happened before. In fact, before a few weeks ago, the only time that even one weekly candle had closed below the 200-week moving average was in March 2020. This is the COVID crash, of course, and that only lasted 1 week. The bounce was immediate. The very next week, the price recovered and closed above the 200-week moving average. So that is clearly not the case this time. A close at the current level, or even a bit above the current level, would be the fourth straight close on a weekly basis below the 200-week moving average. So clearly, this time is different. The question, though, is, if you're a crypto investor, or if you want to be, and I presume that if you're here on this channel watching this video, you're at least entertaining the possibility. The question is, what do you do now? So that's what I'm going to try to shed some light on in this video. Try to, give you some grounding in a good strategy that you can use right now, and get us all on the same page as we work through this brutal bear market. So what do you do right now? I think that the answer to this question has two parts that both need to be stated clearly. The first part is that you have to decide whether you believe that Bitcoin and crypto will bounce back eventually. This is really the number one question, because if you do believe that prices will recover eventually, then right now is about as low risk an opportunity to buy Bitcoin as you can reasonably expect to get. I mean, if your only rule was to never buy unless the weekly chart showed a close below the 200-week moving average, and then to go all in, you would be an incredibly wealthy person right now. You would have gone all in right there in this wick, or, right in this candle as this recovery and reversal was happening back in March of 2020. And you would be very happy that you did that. Even after this downtrend, you would still be sitting at, a pretty hefty 5 or 6x had you followed that rule. Now, we couldn't have known at the time that that would have been the thing to do. And there's no guarantee that a strategy like that will work out again. So, the thing to keep in mind on the counter argument side, on the more pessimistic side, is that Bitcoin did not exist during the 2008 financial crisis. It actually grew out of the aftermath of that collapse. And market conditions as a whole have been pretty consistently bullish since then. That's 14 years ago. So, Bitcoin has never really been tested the way that it's being tested right now. And this is really a decision that you have to make for yourself. This might not be what you want to hear, but there is literally no one on the face of the planet who knows whether we're in a bear market that's going to last years or longer. And so this is where you need to do your own research, do your own reasoning. And if you're interested in crypto, you need to develop a thesis about whether and when it's going to take its next step forward toward adoption, toward mainstream utility, and toward a new influx of money into the space. You have to be willing to decide that for yourself, and come to a conclusion regarding whether you think the party is over, or whether this is really just kind of sleeping off a hangover so that we can go again. Personally, I think we're sleeping off a hangover. I have my reasons for thinking so. This bear market is roughly in line with previous bear markets, and also major recessions usually don't happen when everyone expects them to. But that's a very, short summary of how I'm thinking about it, and I'm not really going to try to convince you that that's correct. Maybe it's not correct, but that is what I think, and that's the premise that I'm going to go with um, for for this video and for the next segment. And I'm going to assume that if you're here watching this video and you're considering putting your hard-earned money into crypto, I'm going to assume that you think it'll recover at some point too. If not, you can go watch some clickbaity, fear-mongering BS by Andre Jick or whoever telling you that Bitcoin's going to zero, and you can, you know, keep your money in your savings account, and maybe you'll be happy you did that in the end. That's just not the approach that I'm going to take in this video. So that's the first part of your answer to the question of what you should do now. You should decide whether you believe that Bitcoin is coming back ever. If you're comfortable saying yes, which is my answer, then I can help you out with the second part of what you should be doing now. Because if you're going to buy crypto in a bear market, what you need to do is identify the assets with the strongest fundamentals. That's pretty much the only thing that matters right now. And so, really, that's the simple part. The hard part is whether you want to be involved in this space. The simple part is if you're getting your skin in the game, what do you want to be accumulating? And the answer is fundamentally strong assets. This is a piece of research here, a paper that helps to explain why it's so important to be focusing on fundamentals. It also is useful because this tells you when you should be focused on technicals. Technical analysis is useful at times, it's just not useful at other times, or fundamental analysis is more useful at other times, would be a more accurate way of saying it. So, what this research shows is this is a study of hedge fund performance based on whether the funds use fundamental or technical analysis to guide their investment decisions. And what it shows is that both are useful, like I said, but mainly at different times. So, technical analysis is most useful during bull markets because during bull markets, human psychology takes the reins. People get excited and they start making irrational decisions, which drives prices upwards and upwards and upwards. This is called mispricing. There's an irrational price that's placed on the assets, and that's caused by people's irrational excitement and willingness to keep bidding the prices up. Technical analysis is, it's well suited to figuring out where and when that kind of irrational excitement is happening because technical analysis and reading charts is basically trying to interpret human emotions from the charts. Interpreting human emotions during bull markets can be very lucrative. And that's what this article shows. Hedge funds that use technical analysis during high sentiment periods, which means during periods when investors are optimistic, bull markets, those hedge funds do better. Human emotions create bull markets. So in bull markets, try to understand human emotions. That's basically the logic. But it's different in bear markets because people tend to behave more rationally in bear markets. And there are a variety of reasons for this. Part of it is just that people, leave the space, think about other things, are a little bit less trigger happy about investing their funds because they don't want to lose. That's part of it. Another reason why people tend to behave more rationally in bear markets is that it's actually harder technically to short assets than it is to long them. So all of that sentiment, whatever sentiment people have, whatever expectations they have about whether the price is going to go up or down, they can act on that more when it's going up than they can when it's going down. It's just harder to short things. So fewer people who get pessimistic actually place a bet on that pessimistic expectation. And so you get less irrational pricing of the asset to the downside. So technical analysis as a result becomes more limited in how useful it can be when things are in an extended bearish period. That doesn't mean it can't have any utility, but it becomes somewhat less so. On the other hand, fundamentals become even more important and they become really the primary driver of what you need to know in a bear market. Fundamentals determine what assets will even survive in a bear market, get to the other side, and see their prices start to recover. Assets that lack fundamentals might just die during periods like this. We've seen that. I mean, we've seen that with even some of the larger cap assets. I mean, what happened to Luna? I think that um, is a wake up call for a lot of people. It certainly should be a wake up call for a lot of people that a lot of these assets are not going to survive, and this is a period of time that's putting some of the weaker assets to the test, and will kind of prune the crypto tree, so to speak. So if you're holding assets that lack fundamentals, they might just go to zero and never bounce back. And people who have been through multiple cycles often have stories about this. People who held a bunch of assets through 2017, may have made some money on the good ones, but in many cases, they're now holding assets that are worth literally $0. So if you're looking to buy in a bear market, you really want to be sure that you're buying things that have some kind of real value. It's not all about memes or speculation or whatever. It's all about fundamental value in a bear market. So if you plan to stick around and accumulate, you need the fundamentally sound assets. And generally, this is not financial advice. This is just my opinion. All of this is just my opinion. But uh, one good rule of thumb is to stick to assets with relatively high market caps, for starters. And you also want to make sure that there are reputable teams behind these projects, and that they have some utility and some user base. So if we pull up coin market cap here, if we're just looking at the top tokens by market cap, we can see that it's quite a mixed bag, even in the top 10 by market cap. So buying small cap assets is not a great idea during a bear market, but buying large cap assets is not necessarily a great idea either. Um, Obviously, Bitcoin and Ethereum are good. You can never have too much of those. And if you don't want to think any more about it, and if you want to manage your risk and preserve your capital, really there's not much need to go beyond that. Focus primarily on Bitcoin, a bit of Ethereum too. These are here to stay, and you'll probably be rewarded in time for holding your Bitcoin and Ethereum. If you want to branch out beyond that, I think the safest approach is to stick with the top layer one protocols, and specifically some of the top layer one protocols, maybe even more than others. I think it would be reasonable to gradually dollar cost average into assets like Cardano, Solana, Polkadot. I would not touch Tron if I were you. I would not touch meme coins, dog coins during this period of time. Avalanche and Polygon are sound and likely have a future. Chainlink is the leading oracle in the space. It also has a bright future. For a deep dive into why Chainlink is here to stay, this is worth watching. Go over to the YouTube page of Daily Crypto Analysis and check out Jay's video on the subject. So, layer one protocols as a category, but also the top oracle here, Chainlink, which is a major player in the space. But frankly, other than that, I'd be super careful. Even many of the top assets are questionable. Payment tokens like XRP and XLM, for example, they've been underperforming for years. And not only that, but there's uncertainty about whether they will be able to comply with government regulations. This makes their futures very uncertain. So despite the fact that, we look at XLM and especially XRP and we see these large market caps, we know that they have a long history. And so maybe it might look safe during a period of time like this, particularly given the regulatory uncertainty around them. I think caution is advised. I really wouldn't, again, not financial advice, but I personally would not be touching assets like those. Another example among the large cap tokens that I think is best to stay away from is DeFi tokens like Uniswap. I mean, Uniswap has been pretty much down only for 2 years since DeFi summer in 2020, and it basically has no mechanisms to drive demand. Uniswap, like similar DeFi tokens just keeps inflating as DeFi users get paid out rewards in these tokens. So it's hard to see why they wouldn't keep losing value over time, just like they have been. Gaming coins is another category that we can see, here in the top 50. We scroll down a little bit into the 30s, we see Mana and Sand here. These could potentially have success, but there are still a lot of question marks about what kinds of games and token models are actually capable of bringing in and retaining users. So even if crypto gaming takes off in a massive, massive way, as some people believe that is likely to happen, I mean, it's not unreasonable to expect crypto gaming to play a large role in any future crypto bull markets that come our way. But even if that happens, Mana and Sand could easily go to zero if the crypto gaming industry evolves in a way that leaves them behind. It's an immature industry, it's really just getting off the ground. So even the leaders in this space are highly, highly speculative. And during a broader bear market, they are highly risky as a result. Another category that we can look at here, um, you know, things like HNT and VeChain, these utility oriented tokens, which are really experimental attempts to try to disrupt industries. For VeChain, it's VET, that's supply chain management. For Helium, HNT, that's cell phone service. So these are innovative ideas that could, in theory, take off, but they really haven't yet. And it's hard to imagine what kind of catalyst would put them over the edge. So these would be highly, highly speculative bets, even though they are utility oriented. And again, during a bear market, highly speculative bets are highly, highly risky. I could go on like this. What I'm trying to get across is just that almost everything in crypto is hyper risky right now. This isn't the time to be playing games and gambling away real money. So if you're here for the long term, again, not financial advice, but what I think is the smartest approach is to keep it simple, buy Bitcoin and Ethereum, and maybe a little bit of Chainlink or Polkadot or whatever strikes your fancy from among the fundamentally sound subset of the high market cap assets here. Use dollar cost averaging. That means buy a little bit every week or every couple of weeks or every month, whatever works for you, because that way you get a good average entry price over time. And just resist the temptation to play the altcoin casino. There will be a time for that in the future, but it's not now. So, anyway, that's how I think we should be trying to handle the bear market. And I hope you guys found this useful. Thanks for watching.